Hello and welcome to ECCA Masters. Today we'll be covering the second part of Chapter 21, Consolidated Statements of Financial Position. Yesterday we covered the basic format that you have to follow in the preparation of consolidated statements of financial positions. We also discovered the three types of investments that a company can make: a simple investment, an investment in an associate, and then an investment in a subsidiary. And in case of a subsidiary where you have invested in more than 50% of the subsidiary's uh, shares, you have to consolidate your financial statements with the subsidiary's financial statements. Consolidating financial statements means that you have to prepare your statements along with subsidiary statements as if they are one company. So you have to prepare one statement of financial position for both companies combined with their data combined. That usually means in cases of assets and liabilities that you have to add up the values of assets and liabilities and present them together. In case of equity section of the statement of financial position, it was just the data of parent's equity that is presented in the consolidated statement of financial position, although we do have group retained earnings and NCI presented in the equity section of consolidated statement of financial position. uh, Values that we calculate in the initial workings of consolidation. The five workings that we looked at in the previous lecture that we perform in in the build up to the preparation of the consolidated statement of financial position. Those five workings give us the value of goodwill, group retained earnings, and non-controlling interest that we then include in our statement of financial position. Goodwill is included in our non-current assets, whereas group retained earnings and NCI values working from working 4 and working 5 are included in the equity section of our consolidated statement of financial position. Today we'll be looking at a few adjustments that you have to be familiar with. These adjustments you may have to make in consolidated statement scenarios. Wherever you have consolidation questions, whether it's an MCQ or an MTQ, you may come across these adjustments. First of which is the adjustment for fair values. Now, these adjustments are very basic, even up till the end of this chapter, so you should be able to comprehend them. They don't pose you very tricky questions in the exam relating to consolidation because the topic is still new. So, as far as you have a general understanding of these adjustments and you know how to make them, how to perform them, as we'll be covering today, you should be able to comfortably attempt them in the question as well, in the exam questions as well. Do try the kit questions after this chapter. I'll be giving you an idea of which kit questions you can attempt, and then I'll be giving you a final assignment for the kit questions once we're done with chapter 22, because we'll be covering the consolidated statement of profit and loss in that. But we do have ample questions in the lecture, so do feel free to go over these again and again just to get a very concrete idea of how consolidation is working. The more uh, comprehension you have of the concept, the easier it becomes for you to attempt any kind of question on the topic. So we have the concept of fair values. Now, fair values are so important in accounting, and you'll come across them again and again in other concepts as well, that they gave a separate accounting standard to fair values, and that accounting standard is IFRS 13. So IFRS 13 is simply created to cover the calculation of fair values. Now we will not cover this standard in a lot of detail in F3. It will be covered in much more detail in F7. But for now, you just need to be familiar with the fact that there is an accounting standard covering just fair values, and that should tell you how important fair values are. So fair value defines the IFRS 13 fair value accounting standard defines a fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So, fair value is exactly what it sounds like. It is the fair value of something, it is the objective value of something, right? So, for example, let's say you are about to sell your car, right? If you decide to sell your car, if you go to the market, right, and you ask a stranger to buy it from you, the price that they offer you for the car, or the price that you're able to negotiate with a complete stranger, let's say you're able to negotiate a price of $10,000 for your car with a complete stranger, that is the fair value of the car, right? If you were to sell this car to someone you know, someone you are relatives with or friends with, they may be willing to offer you a special price. They may be willing to offer you a special price of, let's say, $15,000, or maybe you may be able to give them a discounted price of $8,000. Now, you see, these prices are not decided between market participants, but these prices are decided between relatives or friends, and therefore these prices cannot be considered fair prices or fair values of the car. The fair value of the car is a price that you're able to decide upon with a complete stranger, that represents the true value of the car that you'll be able to get from a complete stranger, from a market participant, from someone whose sole interest is buying the car, is getting good value for their money, right? And in that case, you are not willing to give them a discounted price either. You are simply trying to sell your car for the maximum price possible, and that is what your sole motive is. So in that scenario, where your motive, where seller's motive is to get the highest price, and where buyer's motive is to get the most value for their money, the price decided between these two groups, this type of a seller and buyer, that is a fair value, right? Now, how is fair value applied in consolidation? Well, consider this scenario here. At acquisition, the fair value of Peppermint's plant exceeded its carrying amount by 200,000. So, whenever a company is about to be purchased, now in this case, Peppermint is being purchased. Peppermint here is the subsidiary. Now, whenever a subsidiary is about to become a subsidiary, whenever a company is about to become a subsidiary, which means that it is about to be purchased by an investor, by a parent company, or it's about to be parent company, the assets of the subsidiary will be revalued, and you will find out what the fair value of the subsidiary's assets are, because that is the value we will then use in our calculations. That is the values, those are the values that will then be used in the calculation of goodwill, in the calculation of consideration. Basically, the entire calculation, every part of the calculation involved in buying a company has to be based on fair value amounts, not the carrying values of the assets, of the liabilities. So they may sometimes tell you that one of the assets of the subsidiary, for example, in this case, the plant of subsidiary, has a higher fair value than the carrying value of the plant. Now, the carrying amount of the plant, the amount of plant, the value of plant recorded in the books of Peppermint is, well, whatever it is, it's 200,000 less than the fair value of this plant, of this asset. So the fair value of this plant is 200,000. Fair value of this plant is 200,000 more than the carrying value of this plant. Now, in this case, you are supposed to adjust for this extra value of the asset. So at the date of acquisition, the fair value of the 20% non-controlling interest is given as well, right? So in Peppermint, and this was 380,000. So this is an additional information. We may not use this in our calculation here, but this also tells you another place. It gives you another scenario where the fair value method is used. We also determine the fair value of the non-controlling interest, because we then have to use it to find our non-controlling interest value at acquisition to include it in our equity section. So fair value is used in quite a few places in our consolidation scenarios, but in this case, wherever they tell you that the fair value of the subsidiaries assets is slightly higher or slightly lower than the carrying value of the subsidiaries assets, you have to adjust for this, and you will adjust for this in working 2. Specifically, you will adjust for this calculation, you will adjust for this fair value in working 2 of the scenario. We have net assets at acquisition, we have net assets at reporting date. I'm assuming values here for share capital and share premium and also retained earnings. But here comes the adjustment. Wherever they tell you that the fair value is more than the carrying amount by 200,000, we will add this 200,000 in both the acquisition column and in the net assets reporting column at as fair value adjustment. So basically, we are showing that these net assets, the share capital, share premium, and retained earnings, these are the net asset values at carrying value. But one of the asset has a slightly higher fair value, has 200,000 more fair value than the carrying value. So we are adding that extra 200,000 here in our calculation. And this is how you adjust for the fair value of assets in your net assets calculation, because this fair value will be determined at the acquisition date. So you have to add the extra fair value, the extra amount of 200,000 in both the acquisition column and then in the reporting column as well. If they told us that the fair value of the plant was 200,000 less than the carrying amount, in that case, we would have subtracted 200,000 from this calculation. But in this case, because the fair value is more than the carrying value, we are adding the extra value in our calculation of 200,000. So once you've made this fair value adjustment, the rest remains the same. You total the net assets, you then take their difference to get your increase in profit, increase in your uh, 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 net assets, basically your post acquisition profit, profit after acquisition. Now, this fair value of 200,000, it will be added here in the net assets calculation. And then when you're preparing the statement of financial position, obviously you have your property, plant and equipment presented in the statement of financial position. So we have Hazelnut, which is the parent, consolidated statement of financial position. And you see in the non-current assets, we have property, plant and equipment. So we take parents property, plant and equipment, we add in that subsidiaries property, plant and equipment, and we're also adding the fair value of 200,000, because this 200,000 is supposed to be included in this uh, net assets of property, plant and equipment of subsidiary, but it's not included there. So we are adding this fair value, extra fair value, in the property, plant and equipment calculation as well. So just like this, wherever you have a fair value, some extra fair value of your non-current assets, you have to add it in the net assets calculation in acquisition and reporting columns. And then in the preparation of your consolidated statement of financial position, you also have to add this value in your property, plant and equipment. Obviously, if the fair value was less than the carrying amount, then we would have subtracted the 200,000 both from acquisition and reporting columns, and we also would have subtracted the 200,000 from uh, uh, property, plant, and equipment amount as well in the statement of financial position. So, this is how you adjust the fair values in your consolidation questions. Then we have the concept of intra-group trading. Now, intra-group trading is transactions between parent and subsidiary after they have become parent and subsidiary. So let's say the acquisition of the subsidiary took place on 1st January 2018. So any transactions that take place between the parent and the subsidiary after this date are known as intra-group transactions. Now you can imagine that when we're preparing the statement, the consolidated statement of financial position, we are preparing this statement as if parent and subsidiary are one company. So the intra-group transactions do not make sense when it comes to consolidated statement of financial position, because in that case parent and subsidiary are one company, and intra-group transactions are transactions that have taken place between these two companies, between the parent and the subsidiary. So when we're preparing the consolidated statement of financial position, how can we present the intra-group transactions in there? Because it's one company, so how can a company transact with its own self? That's not possible. So in this case, basically what you have to do is figure out the intra-group transactions. Intra-group trading are transactions that take place between the parent and subsidiary after acquisition, and we have to adjust for these intra-group transactions. So the first adjustment we have to make for these is for any receivable and payable amounts between the parent and the subsidiary. So let's say we have a scenario here, right? We have a parent acquiring subsidiary P acquiring 75% of S on 1st July 2015. So that is the acquisition date. We have the retained earnings given. We have some extra information here as well. So we just need to look for the information relevant to our intra-group adjustments. P paid 3,500 for its investment, right? We have the consideration amount. Again, we don't really need these in this scenario. At the reporting date, P recorded a payable to S of 400, right? So we have a payable recorded in P's account of 400 that is payable to S. And this agreed to the corresponding amount in S's financial statements as well, which means that in S's financial statements, there is a receivable recorded, a corresponding amount here means a receivable recorded of $400, right? Now, these amounts should not remain recorded in the receivables and the payables amount of these companies when preparing the consolidated statement of financial position. So we have these two amounts recorded in the accounts of the parent and the accounts of the subsidiary, which should not be presented in the consolidated statement of financial position. And uh, for these amounts, we have to make adjustments in the receivables and the payables amount. Basically, when we're adding the receivables amount, we have the receivables amount of the parent here of 1400 and the receivables amount of the subsidiary of 650. We'll add them obviously when we prepare the consolidated statement of financial position. And from these amounts, we will subtract the 400 that is receivable between them from the receivable amount to get the final receivables amount to be included in the statement of financial position, that is 1650. And then we'll do a similar thing with the payables amount as well, where we have the payables amount of the parent and of the subsidiary. We have the payables amount of the parent and of the subsidiary here. So we will subtract the amount that is payable between them from the calculation. This 400 will be subtracted from the payables calculation because this payable is between the parent and the subsidiary. So it has no value, it has no relevance in the consolidated SOFP. And that is why we will subtract this from the payables calculation, and that is how we'll get the final payables amount to be included in the statement of financial position, consolidated statement of financial position. So you have to remember uh, the amounts that are common between the parent and the subsidiary, the receivables and the payables amount, if given in the scenario, they have to be subtracted from the receivables calculation and the payables calculation when preparing the consolidated statement of financial position. Alternatively, you can also have, not alternatively, additionally, you can also have unrealized profit in your inventory value, and you may have to adjust for this as well. Now, what is unrealized profit? Well, Why do receivables and payables amount arise between parent and subsidiary? It's because they're selling goods to each other, right? Parent might be selling to subsidiary, or subsidiary might be selling goods to parent. Now, unrealized is profit made on sales to one's parent or subsidiary. So, for example, if subsidiary is selling some goods if parent is selling some goods to the subsidiary, they'll be making a profit on these goods sold, right? And just like that, if subsidiary is selling some goods to parent, then the subsidiary will be making a profit on these goods sold. This profit is known as unrealized profit, because from the consolidation point of view, this is not actual profit. This is like taking money out of your right pocket and putting it in your left pocket and saying that you have made a sale. From the consolidation point of view, they are the same company. Parent and subsidiary are the same company. So it is not possible to sell goods to your own self and make a profit on that. And that is why we have to adjust for this unrealized profit. Unrealized here means something that hasn't happened, that hasn't actually happened. So when we say unrealized profit, this is profit that we have not actually earned, because from the consolidation point of view, they are the same company, and therefore this profit is not real. The portion of this profit that remains unrealized by the reporting date should be removed from the records, right? So what happens is, when parents sells to subsidiary, for example, right, now the parent has made a profit here on these goods. Now, when the subsidiary sells these goods to a third party, that is when the profit on these goods is finally realized. That is when the profit on these goods has finally been made. So, if parent sold some goods to subsidiary during the year, if these goods are then sold to a third party by the subsidiary, then the profit on these goods has been realized. Same goes with subsidiary selling to parent. If subsidiary sells some goods to the parent during the year, and during the same year the parent is able to sell these goods to a third party, to a customer, then the profit on these goods has been realized. But it is possible that parent or subsidiary, whoever is buying the goods in this case, may not be able to sell these goods to the customer during the year. Some of these goods may still remain in the inventory of the subsidiary or in the inventory of the parent by the end of the year. Now, the unrealized profit on these goods has to be excluded from the accounts when preparing the consolidated statement of financial position. So we have to remove this unrealized profit from the sales value. Now, if parent is selling to subsidiary, in that case, parent is making the profit, and the double entry to adjust for the unrealized profit will be debiting group retained earnings. Remember, group retained earnings is an equity amount. We want to take out the profit that has not been realized yet, and therefore that will be that profit will be in the parents accounts and will have to be subtracted from group retained earnings, right? That is why we're debiting group retained earnings. uh, Also, we have to credit the inventory amount, because the inventory amount contains unrealized profit, extra value that should not be there, right? So we have to remove this extra value of profit from the value of closing inventory from the subsidiaries accounts. In this case, subsidiary bought the goods from the parent. So there is that extra value in the value of closing inventory that should not be there. The value of this inventory that subsidiary has bought from parent has some extra value which is more than just the cost of inventory, right? And we have to find this extra value, and we have to exclude this from the value of closing inventory as well. If subsidiary is selling to parent, then the profit is in subsidiaries accounts. So in that case, we have to divide this profit between the parent and the NCI, and we have to debit the parents share of the profit from group retained earnings, and we have to debit the NCI with the NCI share of unrealized profit in NCI calculation in the NCI account. And then we have to credit the closing inventory account, again because we have to take out this extra profit value, this extra value from the closing inventory account as well. So basically, we're finding out the unrealized profit amount and we're subtracting it from group retained earnings and from closing inventory if parent is the seller, and if subsidiary is the seller, then we're subtracting parent's share of the profit from group retained earnings, we're subtracting NCI share of the profit from NCI calculation, and we're subtracting the full amount of profit from closing inventory. So let's do a scenario on this one, practical question. Here we have S selling goods to H at a transfer price of 18,000, including a markup of 50%. Now, basically, they have given us the selling price here of goods. Transfer price is the price at which parent will sell goods to subsidiary. In this case, I think subsidiary is selling goods to the parent. Yes, because it's H group, so H is the parent and S is selling goods to H. So subsidiary is selling goods to the parent at a price of 18,000, and this includes a markup of 50%. Now we basically need to find the profit made by by subsidiary on this sale. We have the price here and we have the markup here, so we cannot apply the markup directly to the price, but you may remember from the formulas that we covered in the incomplete records chapter, you can calculate. This is a slightly lengthier calculation. You can use the formula that we covered in the incomplete records chapter. You can use the formula to find the cost of these goods, and then you can take the difference between the selling price of the goods and the cost of the goods. The selling price here is given as 18,000. The cost we have found to be 12,000, and therefore the profit made on these goods by the subsidiary is $6,000. Now this is the profit made on the goods when they were first sold. Now they're telling us that by the end of the year, two-thirds of these goods remain in inventory, and therefore two-thirds of this unrealized profit is still remaining in inventory. So we have to find two-thirds of this unrealized profit. Two-thirds of 6,000 will be 4,000. So $4,000 of unrealized profit is still included in your accounts. So now we have to adjust for this remaining unrealized profit in your consolidation process. So first you find the unrealized profit on the goods sold, then you find the remaining unrealized profit on the goods sold, and now you have to adjust this remaining unrealized profit amount in your uh, consolidation calculations. In this case, subsidiary is the seller, right? Subsidiary is selling goods to the parent. So we have to adjust this unrealized profit in the group retained earnings, in the NCI calculation, and in the closing inventory calculation. So they're telling us H acquired, parent acquired 90% of the subsidiary. So 90% of this unrealized profit will go to the parent, right? So 90% of this 4,000 of this remaining unrealized profit, that is parents' share of profit, and 10%, remaining 10% is NCI's share of profit. So we will debit group retained earnings with parent share of this unrealized profit. We will subtract in calculation form, this 3,600 will be subtracted from the group retained earnings calculation. And then the remaining 400 will be debited in NCI account, or it will be subtracted from the NCI calculation, from working for, that is. And then the total amount of remaining unrealized profit of 4,000 will be credited in the closing inventory, which means that it will be subtracted from your closing inventory value in the statement of financial position. So here in the statement of financial position, you can see that we have current assets, we have the inventory values of parent and subsidiary, and then we're subtracting 4,000 of unrealized profit from the inventory amount. So this is what it looks like in calculation form. So you should be familiar with the double entry of unrealized profit, and you should also be familiar with the adjustments in calculation form, since it's more likely that they'll ask you to give the adjustments in calculation form. So that was the chapter. You can let us know if you face any issues with revising the chapter. I'll be assigning some specific kit questions. You can look up consolidation kit questions from Kaplan kit. They'll be right at the end. However, the questions are mixed for consolidated statement of financial position and statement of profit and loss. So I'll be assigning the final questions on consolidation after we're done with chapter 22. But till that time, you can go through the kit questions to find any relevant questions that are specifically on adjustments to be made in the statement of financial position. Meanwhile, you can go through the lecture again to really familiarize yourself with all the concepts. It's a very new concept, so take as much time as you can with this and comprehend it as well as possible. Um, go through the adjustments again. There's a lot to uncover here. Go through the scenarios, read them. Let us know if you face any issues or have any follow up questions. We'll see you in the next lecture. Take care. Bye bye.